So it's a classic phrase that Graham mentioned, that the most important objective of a money manager or anybody who invests in the market is not to lose money. That's the first rule of investing, is not to lose money, and the second rule is not to forget the first rule. You know, so essentially, there are two kind of mistakes you can make in the market. One is a mistake where you miss opportunities, and the other is where you actually lose money. You know, the essential difference between the two mistakes is that if you miss an opportunity to make money, there's always another opportunity which comes along sooner or later. Maybe in a competitive sense, if you're a fund manager, you might be losing out some opportunities, and you may be losing out on some track record. But if you are able to make it up with other opportunities which come along, it's not such a big miss. But if you lose money, that money is gone forever, and you will actually see a long-term effect of how your money compounds if you lose money. So if you lose 20% of your capital, you need to make 25% to get back to your principal. If you lose 40% of your capital, you need to make as much as 67% to come back to the base line. But if you don't lose money and stable, even if there are opportunities you miss, it's much easier for you to catch up. But losing money in the market does not mean never putting in a trade that loses value. You have to take risks in the market, and there'll be, because of natural fluctuations of market prices, you will never find the exact bottom of a stock or never find the exact top of a stock. But not losing money means losing permanent erosion of capital, or permanent loss in an investment. So I buy a stock at 100 rupees and it drops to 20 rupees. It never comes back to 100 rupees. That's a permanent loss of capital. Whereas I buy a stock at 100 rupees, goes to 90 rupees, and it bounces back. Temporarily, it's a marked down price. But if the company is good and is doing well, I'll recover. That's not a loss. That is actually a fluctuations which are affecting the price.